Hello traders, Gary Wagner here, just about 10:15 in Honolulu, 3:15 in New York. It is Wednesday, 2nd day of December, 2015, and this is the Daily Report for Gold and Silver. We are back in virtual meltdown mode with gold trading off roughly $16 plus on the day, a 1.5% drawdown. Currently trading off $16 and change at 10.52. Now that's just off of a low of 10.50.72, high 10.71.53 on the day. And as I said, we're currently trading under significant pressure as Janet Yellen comes out, makes a speech, and the anticipation is that there will in fact be a rate hike later this month. Silver also off significantly, off about 17 cents on the day in terms of percentage drawdown, down roughly 1.2%, so a little bit less than gold, but it is now trading below $14 at $13.99. The other white precious metals are also trading under strong pressure. Actually leading the way in terms of percentage drawdowns is palladium, 527.75, puts it off about $11-12 on the day, but more importantly off 2.18%. And then finally to platinum. Platinum is not faring as much of a drawdown, only off about 0.5% on the day, or $4 in terms of the drawdown at 831. So as far as other markets are concerned, about the only thing moving up on this latest speech by Janet Yellen is the dollar, trading nominally higher, up about 0.2%, trading at 100 on the dollar index. But we do see Dow Jones Industrial Average, the U.S. equities market's not acting so favorably, off currently about 118 points at 17,770. So what does that mean for gold, and where can we expect to see gold prices move in the near future? Well, the first thing that we can see is that when we look at a daily chart, and that's what I've just pulled up, we've obviously got a bias to the downside. That's not rocket science, but I've created a set of cascading channel lines, basically a bear channel in here, and you can see that over these last couple of trading days, without a question of a doubt, we've traded, although it is a narrow band, we have traded absolutely to the top and bottom of this channel. Now, we're very, very close to the bottom, and the question is, with this news, will we continue in this channel, hit this bottom, and then move back up, or could we actually come and see this channel get broken? So traders, the channel that we were just looking at, the bear channel, was based upon a daily set of parameters, daily chart. We're looking at a weekly chart in which we also have a bear channel in here, and we can clearly see that on our longer term studies, we have broken significantly through this channel right in here. And the question is, where do we think this market could go? Now, this has been something we've been talking about over the last couple of trading days, if not the last couple of weeks. And really to best illustrate where this market could go to, and we've talked about a couple of different key areas, one at 1039 and another at 1000. Now, these studies and these forecasts are really based upon a past performance in past areas in which we saw some either real support or resistance. Now, the first line I draw your attention to is that area right around 1039. And I've simply put a horizontal line in here. Let's go ahead and kind of line that up. And that really matches with this low here as well as this high here. And so it is a significant area. And as I said, that comes in roughly at about 1039. The next real area to look at is 1000. You've got two key areas. In other words, as this market was moving up, and this of course goes back, this is 2007, 2008. In 2008, it hits just over 1,000 for the first time, but cannot hold that. That's where we have a pretty sizable correction that comes into the market, and over a period of a year takes us to an intraday low of roughly 700. And we put a lot of key elements right here. We start a wave count, because this really is the beginning of a major wave up. as well as our Fibonacci retracements use this low area for our longer term studies. But when we look at that, we come up with the next area, which absolutely lines up to 1,000. Now, the fact that we're currently trading at 1053, when you consider that we're only about $50 away from $1,000, it seems quite likely that what we're seeing is really the net result of the traders themselves baking into the current price of gold the realistic realization that rate hikes are highly probable and roughly 2 weeks away. So where does that leave the price of gold long term, and short term, what should our next set of actions be? Well, first of all, as to address short term, it would appear as though there will be continued downside pressure in gold. It doesn't seem to have the same ability to react to global uncertainty, to geopolitical hotspots that have been evident in the market over the last couple of months. We are looking at the final chart for the show, and this basic chart is showing us a couple of things. The price of gold vis-a-vis the spot price of gold as it goes up to this record top over a lot of time, this being 2002 up to the present, and then this lower chart being the U.S. equities markets as exhibited through the Standard & Poor's 500. We talked about, and these blue lines, lastly, but these blue lines represent the initiation of QE1, QE2, quantitative easing 2, and QE3. And we can see that the one net effect we saw when the implementation was executed with quantitative easing is that it affected the gold market in an extremely bullish way and the stock market in an extremely bullish way, not only through QE 1, 2, and then 3, but a funny thing happened once we implemented quantitative easing 3, and that was one, we were already at the top of the gold market, but we had this ceiling at about 1,800 in terms of pricing. But as the quantitative easing or money came out of the system and the belief was that the Fed was going to have a different monetary policy, of course, we saw the price of gold trade much lower and over time really give up for 30 to 40% of its value, but we saw the equities markets gain a tremendous value at that same time. In other words, an inverse correlation between equities and gold. Now, when we consider the fact that gold was trading roughly at just below $800 per ounce before the initiation of quantitative easing right in here, go ahead and mark that. $1,000 is my initial mark, but we could see this market go much lower. We'll have to see, we'll have to take a look at other charts, but right now, gold is under pressure, and I believe through the end of the year, it will remain under pressure, and that has drastically and dramatically changed my forecast. I do think we'll see equity prices move higher, but we're certainly seeing a pullback today due to recent statements made by the Fed. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.